For more, let's bring in Michael Schumacher, head of macro strategy at Wells Fargo Securities. Michael, great to have you with us.
Thank you.
Where are we in this market run?
So as far as the Fed goes, the Fed's really concerned about uncertainty regarding tariffs and trade, et cetera, also spending. Thinks inflation could stay high a bit longer than the market anticipates. You put it all together, the Fed's going to sit. There's no reason whatsoever for the Fed to move anytime soon. And I think what that means is if you're buying Treasury bonds or Treasury securities, you can't expect the Fed to come in with a big rate cut to give you a big capital gain. You got to be comfortable with yield levels and just wait for Jay Powell and friends.
What do you anticipate for yield levels here in the United States, given the lackluster Japanese auction for longer-dated treasuries there?
It's a tale of two bond markets, Melissa. So you think about the shorter-term bonds, 5 years and in, pretty comfortable. We think yields fall slightly there. The longer-term stuff, whether it's Japan, there's not much appetite for 30 to 40-year debt. U.S. people are very concerned about the big, beautiful bill, lots of spending, et cetera. Not a big appetite for 30 years here either. I'd avoid the long end. I'd buy 3 to 5 year securities.
So you talk about waiting for Jay Powell and friends. When do you think they come to the party in a significant way?
Yeah, Karen, I think what happens there is it's late this year. So the Fed's incentive now is to wait. They'll probably go big when they eventually go, but probably fourth quarter, that type of thing. It's not going to be really soon.
How important bond auctions in Japan? Last week they had the worst one since the late 1980s. How important is what's going on to what's going on here potentially?
I think it's a big deal, actually, because when you think about governments globally, the common thread is more spending, whether it's Japan, whether it's here, whether it's Germany, whether it's Canada. Bond markets have to absorb that. And people are saying, you know what? Yield levels aren't that great. Generally speaking, we're not getting compensated. To me, it's a bad omen.
So if yields go higher here on the 10-year, at least, is that a cap for the markets?
I think it restrains markets to some degree. And we're not saying yields go crazy, and I think it's really more the back end, like the 30-year stuff in particular. But it's a headwind. I think that's pretty clear.
So, Mike, when you look at all this, when you digest it all, what do you think about inflation? What do you think about unemployment? Is the economy, so the takeaway, flip the whole conversation on its head and say, what does everything that you just said say about the economy now? Where are we? How good are we? Where are we in the cycle?
The markets are telling this really nice story. If you look at inflation swaps and that sort of thing, inflation's going to be high for about a year and come back to a pretty normal level in the U.S. It seems awfully optimistic. That's what I got from the Fed minutes. That's what we get as well. You wouldn't need much of a lingering effect in inflation to make people pretty nervous. So I think things are priced a little bit too nicely for inflation.
Mike, you just mentioned that when the Fed comes in to cut, they're going to go big, right? And so when they cut in September, is the first cut really since COVID, right, going back to 2020, and then went big, 50 basis points. I think it surprised some folks. What do they go big for? Is it because the data is weakening? That was the reason why the Fed cut. They were worried about the jobs market back in September. Or is it because they can? So really, I mean, it's soft landing versus worries about a harder landing.
I think it's two things. One is because they could. If you look at Fed funds, still very high, above 4%. And the second thing, which Powell has talked about a fair bit, is he says, look, real yields are still very high. So what I think he and the committee want to see is evidence, not that inflation is low, but that it's peaked. So we get this surge from tariffs, wait 3, 4, 5 months, and it comes down a little bit. The Fed says, aha, that's a good thing. Now we can actually afford to be a little bit more aggressive here. We can come in, we can try to get some easing.
And how does your view, if at all, change if the Fed doesn't move, because inflation hasn't shown that it's peaked, because the tariffs remain in place for much longer than anticipated, and or inflation is stickier than anticipated?
I think in that case, and also I guess the other scenario I would throw in there, Melissa, is the idea that spending is high. So think about the Senate tacking on more goodies to this huge bill, and the Fed sits, then what? Yields go up somewhat, probably not catastrophically, but you're looking at the 30-year yield probably in the mid to high fives, something like that. 10-year 5-ish, something of that sort. So unpleasant, but not really awful in the bond market.